Do you want to learn how to lessen your taxes legally? Well, in this video, I'm going to discuss the topics of depreciation and cost segregation. The more tax savings that you have, the more money that you will have available to work for you. Make sure that you watch until the end so that you can learn how to supercharge your tax savings. And I'll also show you how you can use your real estate tax benefits to your W-2 or 1099 income. So disclaimer here, I'm not a CPA or a tax advisor, so please consult with your own team of professionals concerning the topics in this video. Now, to understand real estate tax benefits, you must understand rental expenses and tax deductions. You can use your rental expenses to help lower your tax burden on your rental income. Your property taxes, your insurance, these are all deductible from your taxes in the year that you pay for these costs. So there is another tax deduction called depreciation. Depreciation is associated with the buying and improvement of a property. Depreciation is a phantom expense. Phantom expenses are expenses that are not truly coming out of your pocket. For example, your property could actually be going up in value. However, you will receive this tax benefit as if your property is declining in value. Depreciation allows you to write off the expense of buying a property minus the land value over the useful life of the property. IRS assumes a 27.5-year useful life of residential properties such as long-term rentals and a 39-year useful life for commercial properties, and short-term rentals are considered commercial properties. For the purposes of this video, in our future examples, we're going to focus on short-term rentals. For example, you can use your building costs and divide that by 39 to get your annual tax deduction that you can use for the next 39 years. While the standard depreciation is good, there are ways to supercharge your tax savings. So now I'm going to talk to you about cost segregation. Cost segregation is where a property owner will consult with a team of tax advisors and engineers to perform a cost segregation study on a property. In this method, the building cost would be separated into different elements, which will then be assigned a proper depreciation timeline. So for example, your personal property, which are things such as your appliances like your refrigerator and microwave, those have a 5-year depreciation timeline, as opposed to your land improvement projects, that's like your deck or your fencing, those have a 15-year depreciation timeline. And then the rest of your building costs, such as your roof, that still has a 39 depreciation timeline. So the benefit of the cost segregation is that when you have these varying depreciation timelines, you're able to receive more of your money up front versus the standard depreciation, in which the whole entire cost of the building is spread out over 39 years. So as you can see, there are a lot of benefits to cost segregation, but there are even more ways that you can accelerate your tax savings even further. So now I'm going to talk to you about bonus depreciation. So going back to the example I just gave with accelerated depreciation, where you have elements of your building costs that's divided into personal property, which has a 5-year depreciation rate, and your land improvement, which has a 15-year depreciation rate. Bonus depreciation allows you to take those two elements, the 5 and 15 year, and roll all those deductions into year 1. So this is a massive way for you to receive tax savings. So instead of you just receiving your tax savings over a 5-year, 15-year, or even a 39-year period, you're able to receive much more of your money upfront so that you can reinvest or reach your financial goals faster. Now, if you are receiving any value from this video, please hit the like button below and also share with anyone else that you think can benefit from hearing this. So far in this video, I have been showing you how you can use your passive rental expenses to reduce your taxable rental income. Now I'm going to show you how you can use these same passive expenses to reduce your taxable work income from your W-2 or your 1099. Now, in order to be able to do this, you do have to meet certain criteria. For the purpose of this video, again, we're only talking about short-term rental investors. So if you are a short-term rental investor, you must be able to prove that you are a material participant. Material participants eligibility is based upon meeting one of 7 criteria. One of the 2 most common criteria is either you have worked on your property for 500 hours in that tax year, or you have worked on that property for at least 100 hours in that tax year, and also more than anybody else that has worked on that property in the same tax year. Your cleaners, your maintenance personnel, for example, you must be able to show that you have put in more hours than them. Now let's go through an example. We're going to assume that there's a short-term investor who has a $200,000 income that has just purchased a short-term rental property for $500,000. And we're going to look at this scenario in 3 different ways to show how depreciation, cost segregation, and bonus depreciation can supercharge tax savings. So in our first example, the short-term rental investor has purchased a property and is renting it out part-time. So again, the purchase price is $500,000. We're going to remove the land from that property expense, and we're going to get our building cost, which is $430,000. Gross income for the year is $30,000. And then we have our rental expenses, which equals up to about $21,000. From there, we're able to calculate our cash flow, which is income minus rental expense, which will be $9,000. Now we take into account our phantom expense of depreciation. And if you recall, we are able to calculate our depreciation by taking our building costs. In this example is $430,000 divided by 39. As you recall, the IRS attributes a 39-year useful life to commercial properties, short-term rentals. So in this case, when you take into account depreciation, you're actually reporting a paper loss of a little bit over $2,000. Now, this may not be in actuality a true loss. Your property could be increasing in value, but because of depreciation, you are able to legally report to the IRS that you have had a paper loss on your passive, income. Okay. So let's say, for example, this short-term rental investor is a material participant. He or she can use this paper loss to report against their taxable work income. So for example, this investor makes $200,000 and they're able to report the paper loss of $2,000. So now their taxable work income is $197. So assuming that they have a tax rate of 43%, they're able to save a little bit over $800 that year for their taxes. Now let's look at another example. Let's say this same investor, this time rented out their property full-time. So again, the purchase price, the building costs are the same. This is the same property, but their gross income goes from $30,000 to $80,000 because they rented out their property full-time. Their rental expenses also has increased some because of the fees associated with renting out property full time. So now the rental expenses is $25,000. Cash flow with this property is $55,000. Depreciation is the same, which is a little bit over $11,000 in this case. And the cash flow after depreciation is $43,000. Now, this person cannot claim a paper loss because they're not in the negative. However, this has actually reduced their passive income that's able to be taxed due to taking out of the phantom expenses from their rental income. So next, I'm going to show you the same scenario, but this time the short-term investor used cost segregation and bonus depreciation. So now, we still have the same purchase price, land, everything, but this time due to cost segregation, that $430,000 has been divided into 3 elements. The building cost is $290,000. Land improvement, which has a 15-year acceleration rate, is at $20,000. And the personal property, which is a 5-year acceleration rate, is $120,000. Okay. This short-term investor has rented out their property full time, so their gross income again is $80,000. Rental expenses, the same as in the prior scenario, which is $25,000. And from there, the cash flow of income minus rental expenses is $55,000. The difference here is with depreciation. With bonus depreciation, you will take your personal property and your land improvement, and you're able to expense 100% of that into year one. So here we add 120,000 plus 20,000. You receive 140, but then you also have to account still for your building costs, which you will still receive that every 39 years. So for that, you'll also add about 7,000, which from here you will receive, or you'll be able to deduct $147,000. Now, from this depreciation, if you calculate that with your income from your cash flow, you can deduct an expense of $92,000. You can show that you had a paper loss of $92,000. Again, your property may not be physically actively declining in value. It may be improving in value, but due to bonus depreciation, you're able to report a paper loss of $92,000. So let's say again, this short-term investor is a material participant. They have a W-2 income of $2,000. They're able to show that they have a paper loss of a little bit over $92,000 on their taxes. Now their taxable income goes from $200,000 to $107,000 estimated. And if we're assuming a tax rate of 43%, they're able to save $40,000 in taxes that year. That $40,000 that they saved paying in taxes could be used to buy another property, to fund other endeavors that will enable this investor to reach their terms faster. Now, if you want to learn how we track our rental expenses, check out this next video.